APD has been hammered down over 9% in the pre-market after reporting its earnings. It's now trading at a 52-week low. Is it a great time to buy this company? As usual, we'll look at the historical performance of APD. We'll run through their top line revenue as well as their bottom line net income growth year on year. We'll discuss the health of this company, their total cash versus their total debt. We'll also analyze their total return over the last few years versus their competitors. We'll talk about their dividend safety. We'll look at some of their financial metrics to see whether or not they are a strong company for the future. We'll touch upon some insider buying that we have seen over the last few months, over $5 million worth by the chairman. We'll also take a look to see whether the institutions are buying or selling shares in this company. And we'll take a look to see exactly why the share price has dropped nearly 10% in the pre-market. And don't forget, we will run through the valuation model, getting to the intrinsic value as well as the acceptable buy price, given our investor margin of safety, as well as looking to Wall Street to see what they are forecasting over the next 12 months. So let's take a look at their earnings report. So the headline reads that APD Q1 earnings miss as the Americas unit sales slump. Now, when we take a look at their essential revenue from continuing operations, it came in at $273 per share, which is positive. It is higher than the $257 that they had recorded a year ago, quarter for quarter. But when we look at the earnings per share adjusted versus analyst estimates, $282 was what they reported. It did come in under what management, or in fact what the analysts had estimated at $2.99. So it was an EPS miss as well as a revenue miss. They came in at $2.997 billion, with analysts estimating $3.3 billion. So not great at all. They missed on the earnings per share as well as the essential revenue, and they do mention a few headwinds, one of them being the slowdown in manufacturing in China, lower helium demand, as well as higher costs from a sale of equipment project and currency devaluation in Argentina. So several reasons for this, but one of the main reasons that we do see for the price drop is right here in terms of their outlook for fiscal 2024. Earnings per share, $12.20 to $12.50 is what they're expecting, and we can see analysts had estimated $12.80 to $13.10. And we can see here that for the second quarter, they are expecting $2.60 to $2.75. So they missed on both the revenue, they missed on the earnings per share. On top of that, they are also now looking at a weaker earnings per share than what analysts were targeting for 2024. So let's take a look at the historical performance of the company. They are down over the last year 13%, but remember the market hasn't opened, so this will go even lower. Over the last 10 years, whilst they are up 156%, it doesn't include dividends reinvested, and we can see all-time highs back end of 2022 at around $320. When the market opens, as we can see, a price of around $234, it will be now the new 52-week low. The yield will be touching around 3%, and that forward PE will be significantly lower than that 20. So let's take a look at their top line revenue. What is going on with this company year on year? Remember, we look for 3 to 7% growth. They reported $9 billion in 2019, $12.6 billion in September 23, so their latest annual report. What we notice here is, in fact, pretty much flat, a small drop from 19 to 20. It then increased quite nicely in 2021 and 2022 before staying flat. So yes, overall, over the last 5 years, their top line has increased, but we know inconsistencies of periods of it being flat, periods of negative growth, as well as periods of positive growth. Bottom line net income, what story do we see here? $1.8 billion in 2019, $2.3 billion in 2023. Again, what we can see interestingly is on the bottom line, we do see consistent increases year on year. Yes, it isn't great. There aren't large increases to the bottom line. But whilst the top line has increased with periods of inconsistencies, the bottom line, although very, very small, has been increasing year on year. In terms of the balance sheet then, a quick health check of the company, total cash versus total debt. $2.4 billion in September 2019. The latest report from today, $2 billion. So they're holding less cash than they did 5 years ago, but still a fairly healthy amount. In terms of comparing that numerically and directionally to their total debt, we can see it has increased significantly from 3.3 billion to 11.1 billion. So their cash has decreased slightly. However, we note that their essential total debt has increased more than 3 times, and it is something we will consider in our debt metrics shortly after. So comparing them to a few other companies in the industrial gases, we have Lin, we have Ecolab, as well as a few well-known others. Over the last year, what we note, APD down 10%. Remember, this includes dividends reinvested here. They are one of the worst performing in the industry. What we actually note here, as we can see, half of the companies in the industry have had negative growth, half have had positive growth. Now, when we extend that to the last 5 years, we actually see them as one of the middle performing, up around 74%. Bear in mind, when the market opens, this will go lower, something just to consider. But as I always say, this part of the analysis, it doesn't necessarily indicate any future performance. It is just something we love to add in. Now, in terms of insider buys, insider sells, remember, insider buying, in my opinion, is very bullish. It means management expect the share price to increase. That is why they are buying. Insider selling that we do see here, not necessarily a bearish signal. They sell for many reasons, personal, financial. If we look at the more recent sell, it was very minimal, $28,000. When we look at the buy, we're talking about the chairman, president, and CEO. He has bought, when we look at that in combination, over $5 million worth of shares. And we can see he has bought at different prices. Now, when the market opens, if you were to buy at today's price, you would be buying at a much cheaper price than the chairman, president, and CEO. In terms of the institutional ownership, it sits at 83%. Now, 4 billion worth of sales over the last 12 months. In terms of buyers by these institutions, 15 billion. They are liking this company. They have been buying more than they have been selling. Although, note, the largest buy came in Q2. Although Q4, the most recent quarter, there has been more buying than selling. Again, please don't copy what institutions do. Similar to when we look at past performance, it is just something we add in within our research, but always do your own due diligence. Now, dividend safety score, it looks to be very safe, a score of 95. Market cap, 57 billion. It is a large cap company. Recessionary metrics for the last recession, well, they increased the dividend. Whilst they had below average growth, negative 21% versus the S&P's negative 12%, they had a near recession return, negative 52% versus the S&P's negative 55%. Dividend growth, well, they did increase their dividend just a few days ago. Very mediocre, 1.1%. And what does this tell you? You could argue if you had seen this early on, then you would be able to tell that they were expecting a poor quarter given this very low increase. Remember, minimum 4% is what we want on the channel to keep up in line with inflation. And it's sad knowing that the last 5 years and last 20 years they were offering those double-digit increases. What we do know is they are a dividend aristocrat. They have increased those dividends year on year for 25 years or more. So let's look at dividend yield theory. Now, it states a company is undervalued when the current yield sits above the 5-year average. What I'm going to say now, the market is going to open. This will probably be touching 3%. So we see a severe sign of undervaluation. And this will be much lower, still below the 5-year average of 24.8. So we have a double sign of undervaluation. Do keep in mind, though, we don't look at any of these models in isolation. And whilst the materials sector PE is at 18.5, we would expect this to be around the current PE of Air Products when market opens. So let's remember, with the free cash flow payout, we do focus on that. We do ignore earnings, which is susceptible to manipulation by management through accounting. Below 60%, remember, is what we want. Gives us faith management can offer those double-digit increases. Now, if you are someone who has been following this channel for a while, you would know that this is a massive red flag. This is why we look at free cash flow. Now, look, if you're looking at the earnings below 60%, you'd be happy. It is pretty much around that consistently. 2017, 2018, 2019, 2020, 2021, 2022, the majority of the last 6 years, they have been paying out more in dividends than they've generated in free cash flow, a massive red flag indicator. It should come as no surprise that there was a mediocre increase. 465% is a massive red alarm. Now, 2023, as we're about to see, negative 100% is because in 2023, their free cash flow per share was negative, and exactly here we can see. Something to bear in mind, free cash flow negative, never great, but we can see even before then it wasn't really increasing over the period. These are factors you need to include in your investment thesis. Doesn't necessarily mean it's a bad investment to make, but as long as when you're looking at your margin of safety and incorporating that, do understand these metrics. Sales growth, remember, 3 to 7%, very, very inconsistent. Double-digit growth, 2021, 2022, negative in 2023, not great at all. And we do see 2 years of negative growth. So something to consider there. And numerically, it's gone from 10 billion to 13 billion. Shares outstanding, yes, we love it when companies do share buybacks, returning excess cash to investors. In fact, we see the opposite. They've diluted your position, although very minimally. They have only issued, as we can see here, around 8 million worth of shares. In terms of ROIC, on a more positive note, for this metric, I want to see 10% or more to give me faith management are able to effectively allocate their capital. We can see pretty much here consistently around that 10% or more year on year. 2023, it did drop to 9%, but given the consistency of the last 9 years, that is something I would personally be okay with. Operating margin, nice to see. It is above the minimums consistently year on year. Free cash flow margin, no surprise there given that free cash flow negative in 2023. But it is very disappointing. It is something I would keep an eye on with the free cash flow of APD. Net debt to EBITDA then, as always, earnings before interest, tax, depreciation, amortization. Shows us the balance sheet strength as well as dividend safety. Now, we want a maximum of 3, as we can see here. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.92 in 2023. Now, whilst it is below the 3, do note from 2021 it has been creeping up higher and higher, although 2024 it is expected to come down. So it isn't the worst, something just to keep an eye on, but so far the dividend looks to be safe as well as the balance sheet looks to be fairly strong. Now, before we jump into the valuation, just to let you know, we have released our latest newsletter article running through yield on cost. Whether does the dividend yield size matter? We've also run through other newsletters where we've talked about undervalued companies with strong upside, and also our 7 golden dividend metrics to screen undervalued stocks. If you want to take a look at this completely free, click on the pinned comment below. So let's jump into the valuation of APD. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model, Graham's valuation. We have the earnings per share, growth rate, corporate bond yield of AAA, and we can see here we have a first sign of overvaluation, the intrinsic value at 181 with the market value at 237, although bear in mind we don't look at any of these models in isolation. We then have the multiples valuation model where we have companies in a similar sector and size that we ran through, their average PE multiplied by that of APD to give an intrinsic value showing some signs of significant undervaluation. We then move on to the dividend discount model. Now, very disappointed to see that 1%, especially the last few years, some very nice increases. On average, 9%. Now, I have gone significantly lower at 5.25%. That is something that, again, it can be very subjective, but this is the metric or number I've gone for. This shows a sign of undervaluation, 271 versus market value of 237. We then get to the DCF model with the free cash flow year on year, average growth rate, forward looking per analyst estimates. With the discount rate, we get the present value of future free cash flow. Subtract the total debt, get to the equity value, divide by shares outstanding, and we see a very small sign here of undervaluation. We again get to the intrinsic value, which is the average in today's episode of these 4 models, coming to $270. As always, if you do want to grab a copy of the model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. So we start with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see at 10% it is a buy up to $243. Now at 15% it is a buy at around $229. Now what we can see, it is still the pre-market. The market hasn't opened and it's dropping even further, now $233. So it really depends on what level of margin of safety you want. So you could argue that when the market opens it will go even lower. This personally, it wouldn't be one that I would consider unless we see it around a 20% margin of safety at $216. Now, you could argue we may even see that today. It is down to 233, and I would expect with the market to open, this would come down even further. At a 20% margin of safety, this is one I probably will consider to add to the portfolio. In terms of Wall Street, well, they see a revised forecast of just under $300, so upside of 27%. As always, let me know your thoughts in the comments below. Is this one that you're looking to add or were waiting and now after a significant drop, it is one you are considering? Or did the forward guidance, the revenue miss, as well as the essential EPS miss put you off? And do bear in mind, we did run through as well to see that the CEO, vice, or in fact chairman and CEO had been doing over $5 million worth of insider buying. As always, I'm interested to hear your thoughts. If you enjoyed the episode, smash that like button, hit the subscribe, and I'll see you all on the next one. Take care for now.